15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa. $15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa. 15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa. $15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa.
Thank you, Alex. Please, let us pray. Our dear Heavenly Father, we bow before thy throne of grace this morning. We acknowledge your supremacy, and we know that you are the one who created the heavens and the earth, and you placed man on the earth to make it look like the heavens do. We therefore want to thank you for the opportunity and privilege that you have given us as equity to do that which you created us to do to make this world a better place. As we gather this morning, Lord, we want to thank you for we are coming to celebrate what you have helped us to do. We bless this meeting. For this we pray in Christ Jesus our Lord. Amen. Alex.
Thank you, Bishop. Kindly ensure that your mobile phones are on silent. For those who will be live tweeting, kindly use the hashtag Equity 2022 HY Resorts or Equity 2022 Javier Resorts. The coverage is also online on Zoom, and for the analysts who are following us on Zoom, you can post your questions on the Zoom link. Allow me to invite our team leader, Equity Group Managing Director and CEO, Dr. James Mwangi, to take us through the investor briefing for Have 1 Year results. Dr. Mwangi.
Thank you very much, Alex, and warm good morning to all of you. We are glad to have you. As we said, when we are releasing Equity Group half-year results. These half-year results are coming almost 3 years after the beginning of the COVID-19 health pandemic. So we'll look back on the strategy that we adopted to manage the COVID environment. We'll look then the success, the challenges that we have gone through with that strategy. And then we feel we are at the tail end of the disruption, and COVID has become almost normalized. So as we accept that it's a business environment with COVID added among the diseases that we live with, how do we go forward? And do we need to reset and recalibrate the strategy? Does the transformation of environment or the disruption itself entail transforming the way we do business and how we think about business? So those are 4 questions that we'll deal with, so that there is an assessment of the past, a recognition as to where we are, and maybe more importantly, the way forward. So broadly, Equity has not changed despite COVID on its beliefs, on its ethos, and its philosophies. Our focus and essence has remained. We may execute it differently, but our purpose and essence has remained the same. Our vision has remained intact. Our value systems as an organization have remained. The culture of the organization consequently has not changed. So what might really need to change is the how we do business. So COVID has come, COVID has normalized, but the foundations and the fundamentals of Equity have not been disrupted, have not changed. But the how, the what remains the same, the how we may debate whether we need to do business differently. The second aspect of this is looking at the organization structure. What we have seen is COVID has adjusted the way we do things, and that is reflected in the organizational structure. 3 things stands out in the organizational structure: that these are unusual times, and unusual times require unusual kind of decisions. So we have really strengthened the executive bench. We've realized, this is, it's a new norm. It's the new normal, but complex and sophisticated. So you'll see a huge focus on strengthening executive leadership. The second aspect is we have realized the business to enable the population live with COVID as the new norm. Some protocols will not be shed off of mitigating and managing COVID environment. So we have seen the business becoming more online, the business becoming more virtual. We are seeing customers really now adopting self-service capabilities, and we are seeing third-party infrastructure becoming maybe the channels of choice for the group. What that then means is that the IT backbone, the IT capability has become much more significant. It has replaced the brick and mortar, and we'll see later on, 99% of all our transactions are now outside the branch. The relevance of importance of branch has been tested, and it looks like it has given way to the technology platform. The infrastructure of the bank has changed significantly from brick and mortar to technology platform to enable our customers to onboard themselves, to transact. That is the impact we have seen. As a result, the operational risk that used to be the biggest headache in the bank seems also to have been dialed down, and dialed up, of course, is the technology risk, and particularly the cyber risk. So essentially, our risk department has also shifted significantly to focus we are still interested in operational risk, we are interested in market risk, we are interested in the credit risk, and all the other risks. But it appears that technology and cyber risks, fraud risks, have taken the top focus for the organization. That is the change we're really seeing within the group significantly. The transformation of the business towards technology platform have come with what we have also seen, easing cost of fixed costs, because the customers are serving themselves and the rest. So our physical infrastructure, brick and mortar, needs to be managed, involve a lot of staff. But when we get to the platform infrastructure, customers serve themselves, they use their devices, so the cost on investment, the human capital required is different. And we are seeing as the cost structure of the organization is also changing and positively becoming lighter. The operational cost looks like to become lighter as we shed off the fixed cost, as we go to self-service, cheap or low-cost self-service capabilities, and as we go to third-party variable cost infrastructure. So that is another dimension. Now, all those dimensions are being reflected. Because the bank has become, the group has become more online, the business has become more virtual through digitization, the way we communicate, the way we promote, the way we advertise looks also that seems to be shifting. All these shifts have significant implication on how we organize ourselves. And that tells you why we have emphasized the change on the organization structure, the change on competencies and capabilities in the organization, and we'll continue to see more of the same. But when it comes to execution, breadth and depth of management, we go one slide more, and the way management operates, it's more or the same. It is the how that has changed. And so the decision-making and the focus has remained the same. It's the people who may change. It's the emphasis that will change, but the diversity that is required, the inclusivity that is required in the organization, the competence and the capability, as the interactions, the control systems have remained broadly the same. So it's change, and sometimes it's what they say, the more you change, the more you remain the same. It's really complex. But we have gone through a massive transformation as an organization. And I'm glad that we were able to manage that change and transformation. And then opens up to the external environment. And when we look at the external environment, today we have walked a long way. If we look at the global economy in the recent past has not gone through the turbulence it has gone through. Europe, look at inflation above 10%. US struggling with 8%. Exchange rate, the strengthening of the US dollar against all the other currencies. The value or the relationship or the parity between the euro and the dollar. It's a place we have not been for a long, long time. The weakening of currencies of emerging markets is something we have not been able to see for a long time. And then commodities. So there are four forces that seems to be at play. Commodity prices, courtesy of Russia-Ukraine challenge, and the economic prices, inflation, exchange rate, interest rates. It's a perfect economic storm where there is none of these prices that is under control. And the question is how much turbulence, how long will it stay? There are questions whether it is structural because of the supply side on the commodities, and then if it is structural, how long will it take to stabilize and to get out? That is the environment. Now, so what does it mean? Imported inflation for operating environment. The global economy is completely interlinked, so transmission of all these in terms of whether it's the exchange rate. We see ours, we began the year, was it at 113? Daniel told me last night we closed at 19.75. We haven't seen that depreciation for a very long time of the Kenyan currency. Inflation, I think we haven't breached the 7.5 for a long time. Here we are now above that rate. So when you calm down the economy, the debt position, we are where we are. The ability to pay may not be in question, but the question is how will be the cash flows for the economy? Are we able to export enough? If we are not able to export enough, will we be able then to control our imports so that we don't open the deficits too much? What proportion of our revenue will go to repayments of debts, and what is its implication? With the commodity prices being where they are, how long can the economy sustain subsidy on oil? And can it also do subsidy on food? Those are big questions to the domestic local economy. So those are some of the questions that we are grappling with and are focused on. But then the outlook then suggests that beyond these factors, there is a potential of recovery. There is a potential of recovery. Where the early signals of potential is the resilience of the Kenyan economy, the resilience of the regional economy. If the regional economy remains resilient, if the countries continue to collaborate, if we get the cross-border trade enhanced with the increase of the market size of the common market, then maybe these are support systems that would be supporting us. So we feel that the measures, and we'll see that later, that we adopted to support our customers to survive and to recover from COVID have worked perfectly. And we have asked ourselves, if that has worked, how do we soften the ground for our customers? So essentially, we are now really looking at providing wider opportunities. And we are replacing the COVID recovery, mitigation, and management strategy with a regional economic and recovery opportunity or strategy, so that we shift from mitigation. The first one was a mitigation strategy. Now it's an expansionist strategy. We are not mitigating COVID. It's here now to live with us. We have saved the businesses. They have recovered. They have become resilient. How do we get them to thrive? And the strategy we have adopted is the African Recovery and Resilience Plan. And as you can see, it's not a Kenyan plan. It's a regional plan. It's a continental plan, because we have realized the only thing that can support us to succeed is the market. And the market, the larger the market, the better. So that is why we have leveraged on the East African Community Common Market and leveraged on the African Continental Free Trade Area, the Commonwealth arrangements. 21 African countries are in that market, and seeing how we can leverage on market capabilities to stimulate production. And the only way to stimulate production is then to create a stimulus towards production. And we have looked at production from two perspectives. The first one is productivity gains in the existing production sectors or productive sectors. We've looked at agriculture. How can we double or triple the output or productivity of the agricultural sector? How can we increase productivity of the mining sector? And that is the area that we are really focusing on, to get businesses to really enhance productivity so that they become more resilient. That's where resilience is, where they become more profitable, they become more robust, they become much economically stronger. And once the productivity gains have fully been extracted, then we are saying, what do we do with the outcome or the output that comes from productivity gains? And we are saying, then let's put that output into productive economic outcomes. And that is where we are seeing value addition, we are seeing agro-processing, we are seeing manufacturing, and we'll be focused a lot on financing that so that businesses can expand. They can see the opportunity in agro-processing, in manufacturing, in value addition, while the others are enhancing productivity of the lead economy, and particularly the core sectors in Africa, agriculture and mining. And huge spend is targeted there, a lot of capacitation. But that is not going to be done for the sake of it, is to facilitate trade. And hence, the East African Common Market, the African Continental Free Trade Area, the Commonwealth market. But we want that trade to be two-way: investment, capital flows, and goods and products and services. So it's more of an interconnectedness. And so the promotion of investments, like we have seen Kenyans, 300 Kenyans going to DRC, 120 Ugandans going to DRC, 90 Belgians coming. We are now working with Americans, bring them to the market, see whether they can be part of the value addition, manufacturing, they can be productivity gains, the investment required there, then we are pitching for it. We have partnered with the development banks to say, can we syndicate together? Can you do project financing so that there is enough funding for these sectors? Essentially, we want to boost the regional economy. We want to lead and stimulate the private sector to recover. So it has recovered, it has survived. We now need it to thrive. And so that is where, but as we do this, we are also asking ourselves, what about the domestic economy? The population, and we are saying the population is very well invested in micro, small, and medium enterprises. And we have identified the commitment of investing in 5 million SME businesses, capacitate them, formalize them, and connect them to the manufacturing, to the agro-processing, to the export verticals, and to the productivity gains efforts, so that they populate, they become formalized, and they become active participants in the formal sector. So we'll add to 5 million, we'll enhance their capital, we'll hold them, we'll connect them, and hopefully that is the distribution. That is the mechanism of ensuring that the investment in manufacturing, the investment in productivity gains have a trickle-down effect to the communities. So through the micro, small, and enterprises. So link them, they become they are outsourcing models will be very important, and supply chains, ensure that the supply chains between the micro, small, and enterprises and the formal sector are working coherently. And in the process, we can ensure transfer. So that is where we are really looking to take the economy forward and then become the catalyst. The group, the equity group, becomes the catalyst. It has set aside 6 billion for that, but it has the support of 16 development banks. That is IFC, the World Bank Group, Africa Development Bank, European Investment Bank, and about 14 European development banks. So that funding is not going to be the challenge, capacity is not going to be the challenge. We have partners with Bill and Melinda Gates Foundation, the MasterCard Foundation, the Warren Buffett Foundation, KfW, just to ensure through the Equity Group Foundation, we are able to capacitate the micro, small enterprises, whether it's through training, financial literacy, entrepreneurship training, guarantee facilities, just to ensure they actively participate in that whole process of ensuring that it's an inclusive strategy, nobody is left behind, and it distributes and share the prosperity that will be generated from this strategy. Pillar 5, we have decided to involve the young people more and more. So the need to use technology that attracts them, the need to use artificial intelligence, the need to use innovation as so that we can leapfrog, so we can future-proof, and that we are not we are not investing in legacy systems. The way the region adopted mobile telephony and became a major global leader, can we also develop, become a global leader in innovations in this industrialization, because the outcome is transformation and industrialization. So a lot of technology use, and we are lucky that Nairobi has become home for most of the global technology company research centers, whether it's Google, whether it is MasterCard, whether it's Visa, whether it's Microsoft. Their labs are in Nairobi. So the partnerships and collaboration is what we want to bring to bear and ensure that this integration is bigger. We are focusing on a nearly 400 million market in that area. That is sizable for any manufacturing capability. We are talking of a GDP of 7 countries is significant to be able to support, and the physical and the geography around it is very, very is adequate to support. And lastly, is ensure that this transformation doesn't lead to pollution or adverse pollution, adverse effects on environment. So the investment in clean energy, massive investment in clean energy. And we have been very successful at the household level. We are now going to the enterprise level. We are going to the industrial level, financing hydros, financing transition capacity, energy like LPGs, wind farms, geothermal farms, so that essentially energy utilization is positive in ensuring reduced negative impact. And then, of course, helping the farmers to adopt agricultural practices that mitigate, that adapt to the climate and environmental status of the global economy and contribute. Preservation of our forest and tree planting as a major effort. So essentially, that's the social pillar. Within that social pillar is the question of social investment in health, in education, and in social safety nets. And we know how much the foundation is working on that to ensure that there is inclusivity, nobody is being left behind, and the social transformation happens as the economic transformation happens. And Equity has scaled its education programs, it has scaled its health program, it has scaled its social safety net programs, just to ensure that there is parity between the economic and social engine. It's a balanced growth that allows mutual transformation. So in a nutshell, when you break that, how will the outlook look in terms of targets? We are saying, well, when done, we should have touched the region through 100 million customers, 5 million micro small enterprises with loans so that they're integrated to the verticals, consumers and households, 25 million outstanding loans, and we'll have created 25 million direct jobs within those enterprises, and within their value chains, we'll also have created 25 million jobs. So the recovery is significantly funded by Equity with its partners and capacitated. If you look at that, it looks like Equity is slowly fine-tuning its engines, not just to do commercial banking, but now to do development financing and to be a commercial development bank. It's a breed, we think. And the way we have been able to do that is use short-term commercial loans from the bank and long-term development financing from the development banks. So we are using the balance sheets of the development banks on the job. This investment is very, very targeted. Low hanging fruits are in agriculture, so 35% of the funding will be deployed to agriculture. And agriculture is the entire value chain, including productivity gains, agro-processing, manufacturing, and export, quite a lot. Manufacturing will take 15%, that is non-agricultural manufacturing, and the outcome, if we do it well, we'll become the #1 trade finance bank in Africa, because we want to use efficient tools, not affordable tools. Instead of always thinking credit, why don't we facilitate through trade finance tools? We have the balance sheet, we have the reputation and the brand, LCs, guarantees, and the rest will become very important. So in a nutshell, the lessons we have learned from helping our businesses to recover, to become resilient, we want now to use those lessons to make our economies recover, become resilient, and transform in a very defined way so that we are leveraging. We have used our gravitas to align with the governments in the 7 countries. We have signed understanding. We have developed national plans together in addition to the African recovery plan. And we have now got the development banks to sign, led by the World Bank. We have got the UN agencies in all the 7 countries to sign. So it's in partnership. Our partners, the MasterCard Foundation, the Bill and Melinda Gates, Buffett, each of them has a role to play, and we seem to be in a good place. Now the focus is to mobilize the private sector. Planning is good enough, and it's very important. It's execution that matters. It's getting the factories to be set. We have now started a catalog of disruptive flagship projects that have been implemented, and we will go through that because of this presentation. And we really are happy with the way the map is emerging, with huge flagship projects becoming successful and giving us a chance to validate our aspirations. So huge intent and the way forward. So that gives you a feel of the thinking, both of environment. We could say we have done a scan of the environment. We have assessed the contextual intelligence that we are extracting from the environment. We have looked at where we have come from. We have looked at how we have emerged, how our customers have emerged. But that will become more clear as we go to the numbers. How have the customers emerged? How resilient is equity? How big is the recovery of the equity group? So now that has boosted our confidence that we have done it with the customers. We'll now do it with the economies or markets. Let me use the word market. We did with the customer. Can we do with the market? We did with the enterprise. Can we do with the state? And it's interesting. It's bold. It's courageous. But we have what it takes, because the most important thing is trust. And it has been demonstrated by those who have signed on the dotted line. It's demonstrated by the customers we are taking across the borders. So let's now go to the numbers and see how the numbers speak. And of course, the business model. The business model of equity remains the same we have seen, but with 8 focus areas. And we'll now go a little bit on these focus areas, particularly for the investors. And for the investors, the first one is really the quality of incomes. What is the quality of incomes? And we can see how much the non-funded income is contributing. 39% of the total income of the group is now non-funded. So there is no provision on it. It's realized income. So there is nothing. It's not capital consuming. It's not on the balance sheet. And we are very excited that only for 61% is coming from our loan book, is coming from our fixed incomes within the treasury, and that composition. And then how are they growing? We are seeing interest income on loans growing at 21%, but we are seeing non-funded income growing at 23%. And that gives us huge comfort that the high quality streams of income are growing faster than interest income. Those who really understand the value of income, the pricing of income, the analyst, now you could really see where we sit. If we move on and look at one area that we said we'll focus on, trade finance. The trade finance income has grown up by 64%. So these trade missions that we are taking people, we are not taking them with loans, we are taking them with trade finance. The regional trade, the common market exploits, the African continental free trade area opportunities. We have decided to use the trade finance instrument, the Commonwealth market, and we can see this instrument is also supported with lending, and lending is now becoming more related. What are we becoming? A trade facilitation bank. And we hope will really help the Eastern Central Africa region to increase its trade from 15%, hopefully by the end of this strategy of 2025, to see whether we could have reached 20 to 25% of cross-border trade. And we can see the off-balance sheet items, trade finance. It's really saying the balance sheet is not enough, it's creative really banking to support. Why trade finance? It's more affordable, it's more convenient. So we're removing the barriers of balance sheet items from the balance sheets of our customers so that they could be able to do much better. This is the biggest driver. Treasury. We look at Treasury and we'll see loans are growing at 29%. Treasury is growing at 16%. The risk of the COVID era is over. Treasury placements with government securities is now in a very declining rate. What is accelerating is lending to the private sector. It is lending to the productive sectors of the economy. This migration or this realignment is very, very powerful on the P&L. Because loans that are growing, and we have seen they are growing at 29%, have very high yields compared to the low-earning assets in Treasury. So we are saying we have studied the risk. We have made COVID has become normal, usual business. So we have dialed down the risk and we have opened the taps for lending, and that is why the African Recovery and Resilience Strategy seems to be very well set for us. So the growth is more and more. But even on Treasury, you can see Forex trading. Because of cross-border trade, one of the fastest growing area is Forex trade. And lastly, we have seen we talked about the global economy. Look at the yields on government securities. You look at, yes, the yields have gone up from 9.8 to 10%. The accrued income is good, but look at valuations. The yields at the time we reported on June, the yields on Treasury bonds, Euro bonds, had moved from 8 all the way to 22. And we can see the heat of unrealized capital losses, 60 billion shillings. The good thing, the global economy has adjusted, and we have reflected there. We're down now to close to 45. We have recovered 15 billion. We expect that these will normalize, whether it will take us 6 months. We seem to have done our elections pretty well. We saw what, after voting, what the economic prices behaved. We hope that will correct. So essentially, that is the status of the Treasury function. When you do a more greater deep dive on this, you see that the economies will continue to yield much better in terms of high earning yields, but they can't compare with the private sector. So it is reassigning the investments that have been in government. We have dialed the risk low. Now let's get the funds reallocated to the private sector. And that is the 5 million businesses we want. And those businesses are spread in the entire East African region. Our subsidiary, our expansion strategy has worked very, very well, despite the COVID. And that's what I can tell you how successful Equity was in recovering and demonstrating resilience and thriving. I would say we thrived during the COVID era. You look at our subsidiaries, they are now contributing 42% of all the deposits. They are contributing 40% of the entire assets. So Kenya has been reduced to a 60% contributor to the group. So essentially, we have now become a regional bank from the numbers. It's not from the subsidiaries we have, it's the distribution of the balance sheet. And when we look at the pace of growth, the subsidiaries seems to be growing much faster than we had anticipated. We can see the shift from all through, but the most fulfilling is the profit after tax. They are now contributing 28% of the group profit is outside Kenya, and Kenya is only contributing 72%. We anticipated to be in this position in 5 years. We have managed to get to this position in 3 years. So it's really what we said, the trend seems to be good, and we are better positioned. The most fulfilling ratio is cost of capital. The cost of capital for Kenya is 18%. The cost of capital for the region is 21%. But the subsidiaries are already showing a return of 22.3%. So they are above the cost of capital. And any improvement that now is the benefits to the shareholders. We have already paid the capital, so the model of regional expansion has been validated. And now the opportunity to grow when you have met the cost of capital and the efficiencies are growing. Now, this has had two big implications. The first one is economies of scale. The size that is being produced now in the region, we have become the largest balance sheet. And as we shall see later, it's a balance sheet of almost 1.4 trillion shillings. A balance sheet of that size enjoys enormous economies of scale on shared services. And we see the strength and advantage of shared services. The unit cost of Kenya is declining significantly because the fixed cost of systems management is sharing now with these emerging subsidiaries. So looks like Kenya will become a runaway success, a huge runaway success because it's growing. The margins are increasing as it reallocates from treasury bills to loans, and the cost structure is declining. So we'll see the cost-income ratio looks much better. If we go to the next slide, we can see what is happening. Look at return on equity from 32 all the way for Kenya. And the most exciting is that look at Rwanda. It's almost coming to where Kenya is. Uganda is doing very well. And then when you compare this with the cost-income ratio, look at the cost-income ratios. The progress, look at equity BCDC from 75.8 all the way to 64. We hope and are praying that by the end of this year, BCDC will show a cost-income ratio of 60. Now we start, the jaws are completely opening and opening very fast, so we can see the recovery. The full impact of the recovery has not been seen. because this is what will generate the outcome. So very impressive returns on equity. But we are also very excited about the efficiencies, as can be seen in cost to asset ratio, to return on average assets. All the subsidiaries, the top 4 subsidiaries heading towards 4%, and the other 3 now moving towards 2%. And we expect that. So if you take no other note, kindly take note of this. And it's not the static position. If I were you, I would take the trend analysis, because the past is what it was, the present is what it is, but you can do a comprehensive prediction of the future. Investors, you're investing into the future value of this group. This slide allows you to do a prediction, looking at where it is changing, looking at the economies of scale, and looking at the declining unit cost, because the shared services are now being, we have seen the subsidiaries are growing faster than Kenya. What it means is the unit cost. So cost to income ratio is very, very, very central. Investors, this is the slide that will make you make the right bet, not because of where it is, the trend it is showing. Where is equity likely to be tomorrow? And we can have that conversation, and we can, but, and then is that trend, now we have decided to give you in graphics. If you look at the blue curve, it's Kenya. It took Kenya 16 years to make it to 4% return on assets. It has taken Uganda much shorter, 13 years, 14 years. Kenya 16, Uganda 14. Look at Rwanda. Rwanda has made it within 11 years, and we are very, very optimistic. Tanzania is bouncing back. It missed the earlier one when it almost gave the impression it could do. But look at DRC. It's coming. Will it make it faster than Rwanda? Now, DRC will be a game changer. I've said this before. DRC is half the size of Kenya. DRC is 10 times bigger than Rwanda. DRC is, 10 times the size of Uganda. If it hits 4, and we saw the cost-income ratio from 75 to 64 in just 12 months, if it keeps on galloping that way and comes to 50 with its sheer size, so this again really explains where the group is going. We shouldn't, I'm talking to investors, we shouldn't miss the opportunity, and we shouldn't do miscalculation in our management of our portfolio. That's all that I'm saying. So if we moved on, we'll then see, we talked about the African Recovery and Resilient its plan. It's founded on infrastructure. That's why we are very confident. And we have sampled trade finance, and we have seen how trade finance is jumping. We're very excited with DRC joining the East African community. We are hoping that we will continue to play that role. The trade routes, the massive investment in infrastructure will facilitate that. So it's more of following the trade routes. Equity is following the trade route. It's facilitating. And cross-border investments then allows cross-border trade. And that is the trick that we are using to get the region to significantly recover. And broadly, we know the trade routes. Kenya is very well positioned. Tanzania is very well positioned. Mozambique and Zambia seems to be very well positioned. So the national future of Equity regional expansion becomes visible and tells the bet we had made earlier on those two countries, simply because they rely directly on the trade routes. Last year, we crossed as #1 bank in Kenya, #2 bank in Rwanda, #2 bank in DRC. We're betting this year will be #1 bank in DRC. So you can see how and the investment now is in Tanzania. Tanzania and Uganda. Uganda, we crossed #6. So we are a systemic bank within the region. And that explains how well positioned we are in terms of trade finance. And of course, we have talked about the balance sheet. This is the balance sheet I present to you of 1.3 trillion shillings. And look at the structure, how agile that balance sheet is. 100 of that balance sheet, we look 971 billion is from customers' deposit. We are looking forward to breaching the 1 trillion shilling deposit base before the end of the year. We can confidently say we will now again make it now, it's not the balance sheet, it's deposit base, breaching the trillion shillings. We are just short by 29 billion to reach 1 trillion shillings. That is the balance sheet we are talking about. And then we are saying, look at capital, shareholders' funds, 150 billion. If you add the 60 that have been netted off by unrealized gain, the bank has capital of 210 billion shillings. So the balance sheet, if you add that 60 to the balance sheet is already above 1.4 trillion shillings. So the size of the balance sheet, the question. The only item I want to draw your attention to is the quality of the equity balance sheet. 1 trillion shillings in deposit, 200 billion in capital, 162 billion in long-term debts. So deposit can fund short-term loans, debts can fund medium-term loans, and capital can be used to fund long-term loans. That now positions us to do well in funding industrialization, because the profile of our funding is from short to very long term. Now, when you bring the balance sheets of the development banks through syndication and project financing, then you can see what the capability. So if you had a doubt about the positioning of equity to dare to fund an industrialization of the region, it's very well explained by the size and structure of that balance sheet. It's a very agile balance sheet when you look at the asset side. We have seen how it's funded. But look at the asset side. 365 billion is near cash sitting in tradable treasury bills. We hold all our treasury bills to trading assets. So essentially, they can move over, and that's why there is the revaluation and realized loss, because they are held for trading. If you look at cash, 200 billion is in cash, waiting for a borrower, and loans out of 1.4 billion is only 650. So when we say we have put aside $6 billion, is even if you add the $6 billion, the loan book will still be at 1.2 trillion in a balance sheet of 1.4 trillion shillings. So I'm trying to reconcile those who may say this aberration. How is this? This aberration is really grounded on the balance sheet. It's a very agile balance sheet. Now, for those who like profit and loss, this balance sheet is very, very well positioned, because we are saying the 365 billion near cash plus the cash of 200 billion, call it nearly 600 billion, can migrate to the loan and increase the yields by maybe 400 basis points or 400 basis points. That is the opportunity. And you are then increasing that in a balance sheet, in a loan book of 700 billion. That's really where the next wave of profits of equity will come from. The system is already invested. The models have been built. It's the same stuff that we'll use. But it's the growth of 19% of the balance sheet that also tells you if it continues to grow, this balance sheet then doubles every 5 years. So you start seeing how big we grew. By 2025, we are then talking of a 3 trillion shilling balance sheet without fail. That's a company you are investing in. As a company, you have an opportunity to invest in, and you can see the efficiency gains of this balance sheet. If we optimize this balance sheet, but just reallocating funds from cash to loans, we'll move the income from 2% to 12, 13, 14%. We have not effected the risk pricing model. And remember, the maximum interest we have charged here is 13. We have an opportunity to increase that. The maximum approved so far is 18. With the turbulence in interest rates along the way, we have restrained ourselves so that we can allow our customers to fully recover. We fund them, their businesses take off, then we can price the loans appropriate. So that is the efficiency of the balance sheet. For the analyst, we have tried to decode the silent message, the strength of this balance sheet, the agility, and the opportunity to optimize, which would get the efficiencies of size, economies of scale. And that then gives us an opportunity to look at how that balance sheet. Now, I will spend a few minutes because that we have seen the size of the balance sheet, we have seen the market opportunity. How is equity choosing to do execution? And equity is advocating through Pillar 5 the use of technology because we have tested technology. In 2015, 27.7 million transactions happened through the branches and ATMs. Same year, only 53.7 million transactions were in Equitel. 7 years later, the 27.7 million transactions that happened in the branches, they have just come to 19 million transactions. Huge opportunity not to increase staff costs. Staff costs can only increase now through just increasing salaries to retain talent, not increasing staff. Why? Because the business is not in the staff-based brick and mortar. Look at what has happened. The number as brick and mortar transaction declined by 7.5 million transactions. The number of transactions going through the digital infrastructure has gone up by 12 times. 12 times in 5 years. If you look at the curve, the momentum started to grow wildly when COVID struck from 2019. Look at the gradient of the curve. And that momentum seems to be growing. During the COVID season and period, Equity transformed to an online business. It used digitization to become a virtual business. All that digital 663 million transactions happened on self-service platforms, devices. And those who came to see us were only 19 million. If you remove the ATMs that I have, what it means, branches are left with only 1% of transactions. 99% of all the transactions are on digital or electronic devices. And the question, as a management student, I have asked myself, is what will be the implication on the cost structure of Equity? The cost structure used to be fixed cost. Self-devices, managed devices, has no direct cost to us. Third-party infrastructure is variable cost. If you didn't understand why cost-income ratio for DRC in 1 year is jumping from 75 to 64, and why it should be 50, hopefully by end of next year, is because of the cost structure. And the future value creation will be derived from this transformation. It's the cost-income ratio. And so we now can confidently say, yeah, we now see the entire group coming to a cost-income ratio of 40 before, in less than 3 years, from 48, where we were last year. We will see that alone we are at 46. We can see ourselves below 40 as a group, not as Kenya. And it's simply because of the business model. The business model of Equity transformed. I would add that Equity used COVID as a tailwind to transform itself. It used COVID protocols to change the culture of our customers and the engagement of our customers. The consumption pattern of our products by customers, the way they engage us, completely changed during COVID. We took advantage, and that is I want to pay tribute to the management of Equity Bank. They dared, in times of uncertainty, to transform the business. When everybody was scared, this leadership team distinguished itself, differentiated itself by seizing the opportunity and transforming the business when they didn't need to invest in persuading the customers. The customers were persuaded by the COVID protocols to adopt different consumption and engagement styles. So we fully exploited. There is a silver lining on every crowd. We use this to transform ourselves. If we move on, Alex, we can just look at, we saw the number of transactions. Look at value. Look at value. In 2005, the value of transactions moving from at the branch level was 858 billion. At the mobile, it was only 188 billion. The value of the mobile transaction this year to date is 4.4 trillion. We are not talking about a billion now, 4.4 trillion, while the value of the high-value transaction at the branches is only 1.7 trillion. But I also want to say, look at the change from 2020 to 2022. We successfully supported our customers to survive we successfully supported our customers to transform and to thrive. They didn't only recover. They recovered, they became resilient. We gave loans 29% this year, 29% last year, and what has happened? They have thrived. And it's because of that that the balance sheet of Equity is expanding exponentially. That's why it's growing 3 times faster than the banking industry, despite being the largest bank in the country. It's simply because of what we did to the customers. It has come back to us. And Equity has itself not only recovered, it has become resilient, and it has become completely transformed, and it's thriving. And we'll later on see with the numbers. And we see whichever channel you look. I want to draw your attention to one channel, the Pay with Equity merchants, the bold line. And look at what happened. COVID struck at 2019. It was only doing 13 million transactions. 2 years later, it's doing 52 million transactions. What is that doing also? It is removing cash completely from the retail commerce. The biggest strain to our digitization was the environment. Is the environment digitized as the bank? We were more digitized than the environment. So what we did was to invest massively with Pay with Equity merchants. And that's why we offered it for free, so that we remove the backlog of cash handling from our customers. They now can do digital transactions with their landlords. They can even do digital transactions at the kiosks. We now have 400,000 Equity, Pay with Equity merchants, Lipa na Equity, 400,000. We are hopeful, and I hope Dennis is in the room, that no, the other Dennis, Jao, is not in the room. We are hoping we will have 1 million merchants by the end of the year. We have deployed 2,000 people to do nothing else but to recruit merchants. And I'm glad we're now recruiting at least 3,000 merchants every day. What are we saying? The shopkeeper, the kiosk, should stop accepting cash, pay them using Equity, Pay with Equity. The economy will become very, very efficient. And those who can remember, the money, the mobility, M3, it's called M3, how fast money can move. It will be very significant in the economy. And then there will be no cash. Can you imagine a bank without cash? Without counting cash, because people have to pay in the kiosk. The kiosk then brings the money to us. Everything becomes digital. That is what the investment Equity is making. And it's a massive investment. After 3 years, we will then say, we've given it for free now. We can charge a little bit like the mobile companies charge. Now you can imagine the latents, the revenue that would come with this charge if we charge like the mobile companies for payments, even if it's half of what they do. At the moment, it's just a cost, but you can see the takeoff. We are excited. Kenyans have decided to take it on. And the choice, look at the choice we have given to customers. It's no longer a one-fit-all. The branch has been replaced by about 8 different channels. We started with the fixed channels, then we went to third-party channels, merchants and agents. Now we have introduced 6 devices that you hold in your hands. And that is what I've said. Banking is no longer where you go to, the branch or the ATM, or even to a third-party infrastructure, is what you do on your devices. 6 of the channels that customers can use is their devices. The devices is the mobile phone. If you have a feature phone, you have Equitel, and you have USSD. If you have a smartphone, you have the apps, and you have internet banking. If you are corporate, then you have corporate internet banking for cash and liquidity management. Everybody has been given the device of their choice. Freedom has come. Freedom has come. Equity has introduced freedom. Initially, we democratized. Now, we have given freedom of choice. Now, what has this done? George, it has converted banking to a 24-hour business. You do banking whatever time, wherever you are. Distance and time has been compressed. Now, look at how customers are using that freedom. The fastest growing channel is personal internet banking, what you call retail internet. We thought people were very excited with mobile technology, which is the Equitel growing at 24, but look at the growth with retail internet, 1,081%. And look at volume, 366. Look at EasyPay, what we have just talked about pay with equity, 382%, and volume 314. Demographics are serving us well. Kenya has a mean age of 19. It's a digital generation. They have adopted the digital, and they have moved straight to internet. We kept on saying, oh, the country has no internet phones. Maybe it is not true. We have now decided we'll create our own facility for people in the region to acquire an internet phone. We are hoping the cost of bundles will continue to come down because the choice seems to be smartphones. So essentially, what are we selling now? It's ease and convenience. The growth of the bank most likely will be driven by the ease and convenience. Mobile phones showed us that convenience and ease is valued. We have brought it into the banking in addition to freedom. So when you give people freedom and you give them ease of utilizing that freedom, and you give them convenience in use of that freedom, there is only one way to move. And the customers are really moving. That's why we have doubled the balance sheet in 2 years. I think Alex will go a little bit faster. If we then do the channels, so you can pick any channel, next slide, Alex, and we can see we have broken down into the channels, and this is more volume and percentage, but look at the branches are only doing 1% of transaction, but value only 25. So these are particularly the high value transactions. Normally it's the agents coming to deposit what has been deposited to them. So if we get pay with equity, then branches will not only have 1%, but it will be 1% with zero value most likely, because now you can pay conveniently. So, and then the quality of a bank is always known by the quality of its loan book. Look at the diversification of the loan book. Large enterprises, only 24. SMEs, the small and medium enterprise. And that's why we can get 5 million. That, to us, is what an African bank should be doing. It should be focusing on bringing people up. That's why 43% of our entire loan book is among our people, the micro, the small and medium enterprises. So if you add micros and small, that is 46. If you add the consumer to pay school fees, to pay for hospitals, it becomes 66. If you add the 8 for agriculture, it becomes 70 what? 74. 75% of the balance sheet is in the lead economy, the masses. And even if you look at the 26, it's not corporate. It's local indigenous businesses that are showing very rapid growth. They are not corporate, but they are large enterprise. We don't want to call them small and medium. They are not small and we want to encourage them that Kenya can produce corporate. After all, it produced equity. Equity is not a large enterprise, it's a corporate. So our customers can come where we are and we start really dominating the world. So that is where a lot of effort is going. That's the structure. So when you talk of equity as a community bank, that is what it means. When you talk about equity and shared prosperity, notice how the prosperity is spread. Whether it's farmers, whether it's Gekoba, whether it's everybody has a chance. Every dream is varied. And we've had every dream. Look at the diversification. Every sector, none is ignored. We'll give everybody a chance. And then the diversification, as we saw, 65 loan is in Kenya. DRC is now 20. Uganda 7. We are seeing them coming up. So the sovereign risk continues to be diversified. The currencies, 46% of the entire loan book is in dollars. And that has really insulated equity. And the magic of DRC, it's not only growing very fast, but it's in dollar. I hope it becomes as big as Kenya. It's half the size of Kenya. We can now see in the near future, half of the balance sheet being in dollars, half of the balance sheet being in local currencies. And everybody knows we'll have hedged against exchange rate. The movements will be on opposite and compensating. So the net effect will be zero. And that is the desire of equity. Today I've really done detailed because the analyst here, and I don't want you to miss the future. Today is not about the present, it's what it is. It's about the future. If you can't read the future, each of us today should be a prophet of how the future should be of equity and position themselves and make a prophetic investment because they can see where we are headed to. So that's how the asset, and look at the quality of that asset. I am very proud of my colleagues, the management team, particularly in credit. Look at it. The Kenya banking industry, NPLs, non-performing loan book, is at 14.7. Equity is at 8.5. Last year, I said, Clement, where are you? He made the commitment. He's on track. They are collecting the NPLs to the shock of everybody. What is the magic here? What is the secret? Is we supported people not to fail, but to recover. We gave people 29% additional loans so they can repurpose themselves, they can retool, and they can thrive. We took them to DRC to expand their opportunities. We expect our NPL by the end of the year to be much better than this. I applaud our executives for differentiating themselves with their strategic and managerial decisions. The unique price, if I was to price equity, maybe it's not the balance sheet. I would price the management because they are unique. They have differentiated themselves from a market. If you remove equity from the 14.7, you and me can guess where the industry without equity is. That is how far they have differentiated themselves in. And you can see constants. So there are no surprises. So if you think there will be surprises, look at it. It's consistently being managed. But look at how prudent and conservative they are. Even that 8.5, 94% is fully provided. So there is no hidden risk that will fall through. The provisions have already been taken to the P&L. And in addition, they have taken 26% credit risk guarantees. So you can only see recovery because that portfolio enjoys guarantees of 26%. Of the entire loan book is guaranteed. You've taken international credit risk guarantees. And now that then brings us to more interesting conversation of efficiency. And Alex, next slide, and how we are doing. But before that, this is what we could then cause, say, the loan we did and how the provisionings are and how we are. We took, and I'm happy to say, we accommodated customers through restructuring, rescheduling, and accommodation, 171 billion. 46.6 billion has been fully paid of that 171. 114 has completely resumed repayment. Only still in accommodation is 11 billion. Of that which has resumed resumed, we have identified maybe 8.1 is training. We have made provision for that 8%. That's why the coverage is 94. For those still to resume, 11 billion, we can see 2.7 might be training. We have decided to downgrade that portfolio and provide for it. So there is no risk in their own book. And that is why, if you look at the cost of risk, it has normalized. We're at 1.3 below our long-term average, full cycle risk of 1.5. We are down to just 1.3, and we can't see the risk preying on. And then efficiencies. We talked about what is happening to cost-income ratio. We have come down this time last year, 48.5, 46.7. David, our finance director, says he can improve this. I hope David to 45. He has nodded. So we can see where we are headed to. So when I talked about 40, if David is in 3 years and David is saying this year you'll attempt 45, that's what we meant by efficiencies. And cost to asset ratio, look at how it is declining. That is the management attitudeness. That's really the value. And that's where the value. Alex, the next slide. No, you have jumped one. This is very important. As we reallocate money from cash to lending, see what is happening. The net interest margin has moved from 6.4 to 6.9. And we can see at the same time, yield on earning assets have moved from 8.9 to 9.7. At the same time, cost of funds have remained where it was, 2.8 to 2.8. And that's what I said. The jaws are opening widely. The more we reallocate, the more efficient, the more the yield, the more profitable. So if you look at the profit of the bank, I have explained where it is coming from. It's the magic of management. It's the decisions they are making. It's the quality of decisions which differentiate Equity. Equity doesn't differentiate itself with a name, Equity Group. It differentiates itself with the quality of management decisions that are constantly made. I hope they will continue to make those quality, well-thought, prudent, and very informed decisions. Yes, Alex, let's continue. And Equity is all about shared prosperity. I have dealt with the economic engine all through. Allow me now to deal with, briefly, the social engine. Since this is the Equity Group Foundation. Now, at independence, we said we had the 3 enemies. Ignorance, poverty, and disease. That's what this foundation is all about. Look at education. 46% is under wings to fly. Secondary education. 33% is university and TVET education. Equity has devoted itself to solve this problem to the best of its ability. But it's not solving this problem, but creating leaders who it can partner with in the future to solve these problems. So that is why it transits from education to leadership, so that we create a critical mass of people who can do it. Look at poverty. 9% in financial literacy, 2% in agriculture, and energy 6%, 15%. And health has started becoming a significant aspect. 4% is now in, that is investment we are making. A total of 67 billion Kenya shillings. We put our money where our mouth is. $583 million to fund these massive programs. And the next slide, Alex, that is shared prosperity. If you want to see how that is distributed, there it is. It tells you. We are glad that before the end of this month, our equity Afia clinics will have seen 1 million patients. We're now seeing 50,000 patients per month, Dr. John. And you can see last month, that June, we were at 792,000 patients. What attracts people to Equity Afia? Quality, affordability, and professionalism of the doctors. We talked about building future leaders. Equity Afia clinics are all managed by Equity scholars, the ELP leadership program. So that we can see the relationship that we can do. I appeal to you to join us in tree planting. We continue to plant trees. We have planted 19 million. We hope in the next 2 years we'll make it to 35 million trees that we committed ourselves to. But we discovered the big thing is not in planting trees. The big thing is removing people from cutting trees for fuel. And as you can see, how much we are focused on energy devices. And we're investing substantially to ensure everybody uses clean energy and allows the trees to grow without reverting to them. The most exciting one, we now have 150 top schools in Kenya with about 300,000 students all moving away from using trees, and they are saving 40%. We have now turned to clinics. By the end of this year, we hope we'll have done 1,000 schools of the top schools, and you will see how quickly our forest will regenerate. Schools use 1 million trees every month to fuel their kitchens. Now we have put schools, universities, hospitals. Kenya will regain its forest cover. And Eric, maybe you could start. We are very proud because you are saving our future. Let's give this man who is reading. And Reshma, you can start. Now we have paired her with a specialist on ESG, so that team has a lot to do. Thank you very much, Alex. Let's go to the next slide. Now let's go to what do people think. Sometimes it's good to think highly about yourself, but it's more important to see what others think about you. And rating agents, whether it's Moody's, whether it's GCL, they think our risk is as good as the sovereign risk. So Equity enjoys Brad Finance thinks we have developed the 5th best finance brand on earth, and we are very humbled by that. The top bankers think we keep on improving. We now position 22 of the Africa's best bank out of maybe 1,000, and we are number 761 worldwide. But what is important for me is we are rated 39th best bank in return on assets, 71 best bank on earth on return on capital, and 149 most solid bank on earth, and on and on and on and on. We are very proud of these accolades. We are very proud of these awards. But it's in Kenya, at Kenya, Gerard and his team. Gerard, where are you? And his team. He seems to be taking 75% of all bank awards in the entire country. And as you can see, it's number one, number one, number one. In every category, he took number one in 18 categories. Thank you very much, Gerard, for doing us proud. And we can go. And this is something we hope our customers and all stakeholders should be very proud of. Kenya producing, and Africa producing, the 5th best banking or financial brand on earth. It's not a mean achievement. Sometimes we don't celebrate enough. I celebrate that country, when it comes to banking, is right at the top. You can't miss it because of where Equity has placed it. And being in the top 50, it's not every day Bloomberg says you are in the top 50. Thank you very much for making us to be recognized. But this was the most humbling award, the Oslo Business for Peace. Some people call it the Nobel Prize of Business, for us to be told that our everyday efforts contribute to a peaceful world. This was very, very fulfilling. And if for nothing else, this award could make us, all of us, redouble and commit ourselves, because we need a more peaceful world. And this is Shogam. We were very honored to be allowed to provide the keynote address to the Shogam Business Forum in Rwanda. And that mobilized the entire community. We were given a chance to speak to the presidents and articulate the African Recovery and Resilience Plan. We went on to the East African community. Next slide, we went to the African, Alex, next slide. Oh, there are no more slides. So essentially, we moved on. And the market seems to have said, we're doing well. We are 60 billion shillings bigger than the next largest bank in Kenya in terms of market cap, and we are really humbled. We are over 100 billion shillings bigger than the next banking balance sheet in Kenya. We owe this to our customers and the Kenyan public and the regional public. We could never have dreamt this, but our customers made it happen. We enjoy the trust and favor of the customer. Let's now go to the numbers. Those were stories. Now let's start the numbers. I needed you to understand the numbers, so I was laying a lot of ground. And the balance sheet, we said, of 1.33 trillion, and we saw 60 billion will come back when the markets reverse. And we can see, we have talked about this. If you look at the fastest growing line is loans to our customers. That's where, and that is what I call reallocation. If you look at where the reallocation is coming from, it's cash. Cash is now growing negative. So we are moving from low earning assets to the highest category of earning assets. And at the balance sheet bottom, you can see the mix of funding of this group, the faith by international lenders, the faith by the customers, but more significantly, the faith of our customers. When you look at how then we use the processing of this balance sheet in the P&L, net interest income matches the growth in loan book, 29, a cent for a cent. The loan grew by 29%, income from the loans grew by 29%. That validates everything we said. We didn't change interest rates, we didn't change anything. We maintained to support the customers to grow. Interest expense, because of the debt, grew a little bit faster, but net interest grew by 28%. As we said, non-funded grew by 26%. Total income grew by 26%. Our total costs grew by 22%. If you look at what the biggest growth of cost is mainly in staff. We said we didn't need to reward staff. We need to hire the right people, provisions, maintain them at 94%. And as a result, we were able to generate profit after tax of 24.4 billion, up from 17.9, a 36% profit growth. And earnings per share to the shareholders, to the investors, grew by 35%. And so we could see the trend for all stakeholders. It's not just the customers who are happy because the loans are flowing, opportunities are being opened. We have not forgotten the people who have funded this bank, the shareholders. Efficiency is contributing 36% profit after tax, and the return is straight going to return per share of 35%. But how are we sitting in terms of ratios? How this is where then you could really tell how the ratios are sitting, and we can see the yields on interest earning assets have increased from 9.2 to 9.7. Again, I emphasize the improving returns. The cost of funds have remained fairly constant. Cost-income ratio coming down, whether it's with provisions or without provisions. The returns hitting 29% on average equity, and return on average assets for the entire group, nearing 4% at 3.8. NPLs declining from 10.7 to 8.5. Cost of risk, as we said, at 1.3, much lower than the full cycle at 1.5. But we are seeing now loans to deposit ratio. We optimize profitability when deposit loan ratio is at 85, so you can see the 20% weight. Now, the most important aspect for the shareholders is you have well capitalized your group. If you look at core capital to risk-weighted assets, we are at 15.5. The regulatory requirement is 10.5, so we are fully and well capitalized. Total capital to risk weighted, we are at 20.2. The regulatory requirement is 14.5. So we have significant capital buffers to allow us even to take the risk and to reallocate from risk, non-risk asset of cash to risk asset of lending. We don't have a challenge. Everything has been fixed. If you see the spike and ask the spike, what is it? During the COVID area, we were very, very conservative. We were computing capital ratios more conservatively by the central bank. With the COVID normalizing, we have decided to go back to the regulatory capital computations. We have explained it very well with that note. So that is where we are in terms of performance. Liquidity is still at 53, and the forecast look good. We think we'll maintain the growth in loan book within where we expected. We need to do better on deposits. Interest margin, we are almost getting where we intended. Cost of fund, we need to do much better. Cost-income ratio, We hope we'll hit the target. It's a stretched target. Return on equity, or we are within the range. Return on assets within the range. Cost income, we hope we'll be able to do NPLs. We're working very hard to be within the range. Subsidiary representation, regional business is within the range. Return from the regional subsidiaries within the range. So we affirm that we are fully committed to the forecast we gave you at the beginning of the year. I want to thank you most sincerely for listening to us and then give you an opportunity. And we can take quite a number of questions. At the very end of the table, Mary Ntere will respond to financial reporting. She will respond to loan issues or investment issues. Brent, the strategy, the African Resilient Plan, Mary on governance, subsidiaries, and Sam, you can direct all the questions on risk. If there is any question that you don't know how to allocate, I will try to take it. Thank you. I can see the first question from George. We can give him the mic, like there. I hope we can get somebody else with a mic here so that we can be taking a couple of questions at a time. George, go.
Yeah, Doctor, you have commented on everything except the presidential petition.
Every day, over 15 million members are transforming Africa. $15 million members empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa. 15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa. $15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member.
output for Kenyan farmers and agro-processing and value-adding those 50 kg bags of tea, we want to ensure that there is access to markets. With this industrialization that we are looking to drive and support in the Kenyan context because of the question that was asked, there is required investment which may not necessarily be present to the extent that is required in Kenya. So these trade missions that we do their capacity and their opportunities to a country like the DRC and vice versa. Pillar 4, which we've historically been known for in terms of micro, small, medium-sized businesses, we want to ensure that growth in Kenya is inclusive. We want to ensure that the businesses in Gikomba are connected to the businesses in the industrial enterprise area. We want to be sure that distributors are connected to those manufacturers and vice versa. We want to ensure that the smallholder farmer, the subsistence farmer, converts into an agro business and accelerates its transition from a small to medium to large commercial farm. Pillar 5 is what we do with the capacity building. We appreciate that the businesses that we want to connect to these formal value chains in Kenya are not at a state where they are readily acceptable or are able to be connected. So a level of capacity building is required. So our wings to fly, our entrepreneurship training, what we do in agriculture with smallholder farmers remain relevant through time, we believe. Pillar 6 is we want to accelerate this wealth transformation. We want to ensure that we can leverage off the technologies, and James has talked about how the business hasn't changed what it intends to do, but it's changing how it does it. We're moving, or more importantly, the customer has moved away from the brick and mortar to the digital platforms. What that is also meaning is that businesses are accelerating their connections to marketplaces through what we're doing with the e-commerce, what we're doing with payment gateways, APIs. So to the question that was asked, the first question on the relevance of equity, our relevance remains underpinned by our corporate philosophies of social and economic transformation. This Africa Recovery Resilience Plan and what we intend to do in the Kenyan context, we believe remains relevant, because ultimately what Equity Group is looking to do, and given its size, where we are the largest bank, the most systemic bank in Kenya, we can have real impact with what we want to do with the reallocation of the balance sheet from the liquid assets that are sitting ready for us to allocate to the productive side of the economy, i.e. what we're doing in Pillar 1 to the agriculture, the manufacturers, what we want to do with trade, and what we want to do with the micro, small, medium-sized businesses. So we believe we remain relevant because of our anchoring in the social and economic transformation plan. Thank you.
Any other question? Oh, yeah, thank you.
All right. Thank you. My name is Brian George from NTV, Nation Media Group. Dr. I know the last time we spoke in Arusha I was at KTN. I have 4 questions. This perhaps goes to Brent on the expansion plan that's targeting Africa, on the productivity gains, the partnership that targets Africa. Dr. said that there are corporate, or rather there are private players that are targeted. What would be their role now that he enumerated the partners who are largely foundations and one Bretton Woods institution, which is the World Bank? What then would be the role of these private sector players, And who are you targeting? Are they just in Kenya or are also in the subsidiaries in Uganda, Rwanda, and the like? Second question is on risk mitigation. Using Kenya as a use case, particularly, and with the target that's targeting the businesses in Africa, we have a high startup mortality rate in the country. And we understand that Kenya, particularly at the onset of COVID in November 2020, they introduced what is called the Government Credit Guarantee Scheme. So are there any other arrangements with the other jurisdictions in the subsidiaries where equity has its footprints in to mitigate against the risk? Because again, 1.4 trillion Kenya shillings is not pocket change. So what are the other mitigation measures around that? And then will equity renew its lending rate that is currently pegged at 13%? And then lastly is basically, are there reactions from clients with this protracting election cycle? Are you getting a lot of perhaps requests on moratoriums and the like? Thank you.
Let me touch a little bit about expansion. As you likely saw, instead of focusing on the countries we will be in, we are now focusing on the number of customers we will reach in Africa. And we have targeted that at 100 million. We should have 100 million customers. Of those, at any point in time, we should have 25 million families having loans. We should have 5 million businesses holding loans at any point in time. We have also said that the farmers will take 30% of the loan, the manufacturers will take that. So the thinking is now laser focused, is very deliberate, is very intentional. Instead of counting countries, let's look at the people. We are becoming more people-centric. But as I said, we are guided by trade routes. So if it is necessary to occupy a trade route so that we enable it, we facilitate it, where is a trade pattern, it will be good. It's good to say we have a rep office in Ethiopia. Ethiopia is 100 million people if it comes on board. It's also good to say that when we were discussing with Bob Diamond, we had an eye in Zambia and Mozambique, and you can see that corridor of natural resources. But we also said we want to deepen our, not just how many countries are we in, but what is our impact and significance in each country. And we are really committed that by 2025, every country will be in the top 3 banks, because then it gives us the systemic power. It gives us gravitas to negotiate with the government, help transmission of policies, because you need transmission of policies for environment, so that, and because we have chosen to work with the government for development, then that becomes really critical. Let me also, you asked, we are looking at private sector. If you look right now, we have had the East African Business Council, because this facility lending is to the private sector. But as Brent indicated, the Kenyan private sector has done very well, but in terms of size, it may not be the size required in some of the sectors. So we had, for instance, Joy returning from US, and now we have managed to attract 3 companies that have expressed interest to do batteries in DRC. So we are financing them. We are recently in Zambia. We have agreed with the DRC and Zambia. We will co-partner with them. The special economic zone they have put on their boundary for value addition in the mineral resources of Zambia and DRC. So it is then in such a special economic zone. I think we have been in UK, we have talked to about 6 companies. We're intending to go to Germany. We've been to the US. Why? Because they have very deep pockets. Yes, we are doing debt, but the owners need to bring capital. So we are trying to get the private sector global capital to come and flow. If you look, and I'm glad I've been with Grenico, the other one is what? Yeah, all those global companies, and go and challenge them. You are mining in Africa, but you are setting up factories in China and Europe. Why don't you set the factories here? We'll help you negotiate, we'll take the credit risk, you take the ownership risk. And I'm really glad companies like Somaika now have agreed to process copper in DRC. So the value addition has really started. You go to Uganda, I think we now have managed to get the Americans and the Europeans to support the largest biofarm in Africa in using the latest technologies so that Africa doesn't no longer need to buy vaccines from outside the world. It's going to produce, and I hope the factory will open as soon as September. So essentially we have this flagship. We have seen, for instance, the fuel that comes from Eldoret and Kisumu to go to Uganda, and Uganda have said, why don't you help us to remove all these oil trucks from the roads? And we have funded 4 barges that now will be transporting fuel through Lake Victoria. Each of them 4.5 million liters. So the 4 of them will remove 1,000 trucks from that trunk road. So these are the flagship projects that we're trying to really get going. Some of them will require global capital. That's why we are going. Joy, I don't know whether you can get a mic and talk maybe about a few of the private companies that we're in negotiation with for investment in the African continent.
Sure. Thank you, James. We have been traveling quite a bit, speaking to private companies in various countries, including France, the UK, the United States. I just came back from the United States where we spoke with private companies. We spoke with the U.S. government, but we also spoke with private companies in Minneapolis and California. The private companies we're talking to include companies like Vermeer. They're the largest equipment manufacturer in the world for agriculture, construction, and mining. We're talking to companies like John Deere, also a huge equipment manufacturer. We're talking to companies such as Arise, which is a very big infrastructure company out of India. We're talking to a company called LLOC, which is a big infrastructure company out of Sri Lanka. So one of the things, we're talking to Siemens Energy, and one of the things that I think we've realized is that energy is something that is very important to drive investment on the continent. So we have actually a strategic plan that goes with the Africa Recovery and Resilience Plan about how to stagger and sequence investment into the continent.
So it is who can bring the required capital. So Power Africa, in the US, we are talking to them, to Generation. We are talking to people like Robert Forrest in Australia for generating power, really people with the global capital required. So that seems to be really the big issue that needs to be taken into consideration. The second thing is, by bringing those ones, they already have the markets. If you talk to Granico, it's the one which have been taking. So it already have the market for the end product. So by bringing capital, we'll be acquiring markets for the produce. And that is the trick. You don't go to disrupt those who have been holding, you work with them. You don't replace them, you work with them because they already control the value chain. So that would be. Let me ask maybe Mary on mitigation of credit. Maybe you could talk about all these guarantees and who we are working with.
Yep. All right, so on the risk mitigation that we have in place, yes, there was the government-funded guarantee funds. Who we've been working with are the international development finance partners. We've worked with Propaco, we've worked with Africa Guarantee Fund, we've worked with MasterCard Foundation. So currently we have guarantees worth 15.7 billion Kenya shillings. These are distributed between Kenya, DRC, Rwanda, and Uganda. So you are right, there is a huge startup mortality rate, and these funds come into place to support those who, they have a good plan, they have a very good business plan, but they don't have collateral that they can offer. So we'd like to say, like, the chance of them defaulting is very low, but they don't have, if they did, you would lose everything as a bank because you have no collateral. So these development partners are saying, no, we want these SMEs and these micro companies to grow. So they guarantee us between 40 and 60%, and we take the remaining loss. We do expect to grow that as we are growing the loan book. They have been supporting that 29% loan growth that you see. With time, we will grow those guarantees. There was a question, I believe, on the lending rates. Have we repriced? We have not this far. The reason for that is twofold. James described what he called a perfect economic storm, where the inflation rate is out of whack, the exchange rate, the interest rates globally are completely unlike any trends that we have seen in the recent past. Because of that, the import bill is rising, the prices of goods are rising, but the spending power is not rising at that same rate. So customers are coming under a lot of pressure in terms of being able to survive, basically. A reprice in that economy may not be the best play right now. So we are keeping our interest rates low as we just monitor the macroeconomic environment. And yes, there is elections as well. We are slightly in limbo as we wait to see the court process play out. So with that, there's a bit of a slowdown in CapEx expenditure. As you'd expect. So we are still in that process of just analyzing when is the best time to reprice. And from the public knowledge that we have, I think Equity is the only tier 1 bank that has received approval from the central bank, at least from the information that is in the public right now. That has created a mismatch between what we can do and what our competitors can do. For example, for the corporate book, we can price up to 16%, but our competitors are still stuck on the up to 13%. So if we were to reprice, we would basically get ourselves out of that market competitively. So until there's that standardization also from the central bank approval perspective, we're still waiting for that to play out. So we're still biding our time and waiting for that as well.
I think Mary has put it very well. There is a perfect storm. You don't want to worsen it. You don't want to fuel it by bringing affordability into question. So as long as we can be able to hold it, and if you look, we have focused on efficiencies in the bank so that we're able to give a good return. And that is why return on asset is what we are really focusing on. It is reallocating assets to optimize on the balance sheet other than go to pricing, because then you play it. We like the picture we are seeing of NPLs. Because of maintaining low interest rates, then default rate is checked and the growth is accelerated because people are like affordable. I think, Shimeka, maybe you can get the mic and the question to you. This is it is from Jenkins, Mark on Facebook. Listen, Shimeka, it says, DLC pricing up well. DLC is picking up well. Where can I find the rankings of the bank on trade finance across the region? The second part of the question, what is the bank doing to make commercial borrowing for extractive sector? Maybe you take number 1, and Emmanuel can take question number 2. How are you making investment in the extractive, commercially viable through lending? Shimeka first.
Yeah, thank you. In terms of trade finance, what we are seeing in the market, and especially in DR. Hello? Yeah. There isn't so much information that's available. It is an economy that is just opening up. Unlike Kenya, most of the banks don't tend to publish information. So what we've done as a bank is to try and do our own deep dive research so that we can be able to get these numbers. And from what we have as a bank currently, we have become the #1 trade finance in DRC, followed closely by the Raw Bank. We expect that as we continue operating in the market, we will participate with the other partners to try and develop, come up with a system or come up with an industry forum that will enable the banks to be able to share this information, which we can in turn share with the market. So work in progress, but from what we've seen privately is that equity is now the top trade finance in that market. Thank you, James.
Emmanuel, what is the bank doing to make commercial borrowing for extractive sector happen?
Okay, thank you very much, GCEO. Let me just start by saying that currently, Equity has just about 3% of their book in the extractive sector. We are working seriously on making sure that we are able to really increase that book, and that is part of our Pillar 1, basically, which is handled by Brent. So we have started really increasing our presence within the extractive industry in Congo, where there is a lot of copper, cobalt, and others. And these clients normally borrow in dollars. So it's easy to really do a very good pricing in terms of your reference to a LIBOR or SOFR, plus the margins that you have, and just ensure that you are competitive within that market. So pricing is one of the factors that we look at to ensure that we are able to compete favorably with people within the market. The other thing we have done was also to strengthen the skill sets of mining experts within the bank. We have employed project finance guys. We have also gotten one of our colleagues who is from Zambia that has a very good knowledge of mining to be able to support us. Going forward, what we will do is also to set up a mining team or extractive team that will be able to advise us professionally in order to leverage and really increase our presence in that market. Thank you.
Thank you very much. Yes.
Maybe just to add on what we're doing with extractives and consistent with our strategy on capacity building, we recently signed an agreement with USAID and the DRC to support artisanal mining, essentially where we do entrepreneurship training, financial literacy, so that, again, they are better positioned to get access. It's not just about the pricing, it's also about access, which is quite a key step as we look to support the extractive sector in a country like the DRC.
Let's come back to Brian's question. Brian, as you heard, people like John Deere has now committed to put a tractor servicing center in Kenya. So it is not just exporting tractors. How do you service them? How do you maintain them? We've got the same arrangement with the Japanese tractor manufacturer, Tusho. So essentially is complete the supply chain of global to have last mile presence in the region, so that essentially we could make. You asked a question about direction cycle. I talked a lot about structures in equity. I think people underestimate, and I say this from a point of knowledge. I was in the team that was put up by government to formulate Vision 2030 from 2003. And 2007, we started the implementation. If we look what Vision 2030 has built in this country is institutions and structures. I wish, the only regret I had is that I wish we had done the constitutional transformation or the new constitution in the first phase, because the institutions now would be very mature. I think the issue of politics, like the issue of economics, will now be dealt with by the institutions. We see that central bank and treasury, they manage inflation, they manage exchange rate, they manage interest rates in the marketplace. Increasingly, we see the Electoral Commission, the Cohesion Commission, the court or the judiciary, the legislature will also manage our politics and our executives very effectively. It's just a question of where are we in the level of maturity. Looks like the international community is developing respect and the cognition of our institutions. If it was in the past, our microeconomic environment would have been very turbulent, but looks like there is much faith. The behavior of Kenyans has shown a very elevated behavior. And consequently, what one would hope is that elections will be events, and we shall never talk about the election cycles in the same frame of economic cycles. That our economic cycles will not be driven by our politics, because they will be events. They will be driven by the global microeconomic. I'm seeing very good positive signs of trend. The most important thing is not necessarily as it is, it's what the trend. And those of us who could remember the story from 82, the last 40 years has been a very good journey. Yes, we might have been in the wilderness of politics for 40 years, but after 40 years, it looks like you always make breakthroughs. I'm very hopeful. Now, the second question comes from George Joroge, who is on YouTube. Will the projections for DLC be revised now that more Kenyan banks want to be the same piece of the pie, or a chunk of the pie? And I would say we have about 6 regional banks in Rwanda, but we were registered 11 years ago at Greenfield, but last year we were number 2 largest bank in Rwanda. All these banks are in that market. In Uganda, we are number 6, number 5, I'm told by Mary, and we are the largest regional bank. So it is not the number of banks in the marketplace, it's the value proposition, it's the concept of your business model. Equity has entered DLC with a shared value proposition. We haven't seen that as the norm. As Brent has said, we're dedicating a lot of effort, particularly to the artisanal miners, to the farmers. I see Dr. Joan Kolil wish to open 50 Equity Afya clinics in DRC by the end of the year. So you can see the investment Equity is making in society to differentiate itself. We entered DRC 7 years ago with Prop Credit. It was only $150 million balance sheet. Today, we are nearly a 4.5 billion, not a million, billion US dollar balance sheet in DLC. DLC had a good opportunity for, we acquired the two European banks that were reporting to European mother companies. So they were under regulation of the European regulators, that is ProCredit of Germany and BCDC, the Belgium. That was the best assets, banking assets there were in DLC. And we acquired both, merged them. So we have the systems, we have the reputation, we have the capacity. I would say we are head and shoulder above competition. That's why we're optimistic this year we'll close as the largest bank in DLC. We have seen how we have attracted, because of our balance sheet, we have attracted the global mining companies. They're working with us. The new investors coming to DLC, they are coming through us. So, and that is why we are very, very optimistic that DLC in 5 years can even challenge Kenya in terms of size. The second, last thing I would like to say, George, is 25 years ago, we were number 66 out of 66 in Kenya. Same banks that are expanding in DLC were in Kenya, but today we are not only the largest bank in Kenya, but in the region. So it's not how many competitors are in the race. It's the strategy and the value proposition and the focus of execution. In a marathon, people always ask, how many Kenyans are on the race before they can do any bet? So I bet the customers will be asking, is equity available before they can look around? That's really, George, what I'm convinced. But Mary, you oversee the subsidiaries. Is there anything you would like to add?
Thank you, James. Thank you for that question. And I totally agree. What James has said is spot on because what we saw was the size. Based on the population and the demographic trends in that country, and I think we can also say without any fear of contradiction that we've already started making very significant investments in the last 7 years that we have been in the DRC market on innovation, digitization. We are looking at even the leadership structure of that country to take into account the expanse, the geographical expanse of the country, just to make sure that in all the areas the institution is very well governed and the management team is on top of things. We really don't fear competition because we also believe that Equity has created a very, very strong brand across the region. We have created very strong networks and collaborations. And this is what is really driving our business. We have a customer base that is very loyal, but who we are also understanding what solutions they are looking for, what do they need from us, and we are able to figure out how to provide the solutions that they require that are relevant to what they are doing, whether they are on the business side, at whatever stage of their businesses they are, whether they are startups, whether they are middle level, or whether they are large enterprises like James talked about, and my colleagues, whether they are the bigger corporates and they are requiring the ecosystem to be supported and their value chains to be supported. We have invested in systems, very robust technology that is able to support us to become very efficient, but also reach the customers in a very convenient way. And the systems are available 24/7. With all those investments, and I might also want to say, and James talked about this in his presentation, and he kept on emphasizing, that Equity, we have employees and staff members who who are very passionate. We are driven by passion for what we do. We are driven by a passion for our corporate philosophies. And the most important of those philosophies is our love for the customers and the fact that we are able to work together with them day in, day out to be able to provide for what they require, to be able to take advantage of the opportunities that are available to them. We really don't do the business for the customers. What we do is to facilitate them and give them the tools that they require to be able to effectively advance their desires and also achieve their targets and their dreams. And we can say that we are all well on course in that mission. So that has been our purpose. And we are going to continue to tread that path because we know that it can only lead to better success. May I also say that Equity has a big dream, and the dream is to become number one. We love number one because we have become number one in some of the countries, and in Kenya we can say that we love that position, number one. We are liking it so much. So we have an aspiration to become the top bank in each and every location where we are operating. And we know that our customers and other collaborators and partners are going to support us to become, because as you can see, we not only deliver commercial benefit and prosperity, but we are also delivering social benefit and impact in all those regions. And now with the Marshall Plan, we cannot get it wrong. So rest assured, investors, that we are on it and we are going to deliver. Thank you.
Yes.
Maybe, so the question again was whether this changes our forecasts, our expectations for our earnings capacity. If anything, the increased competition, it just reaffirms the initial decision we made to allocate capital in the market. So for us, it's just a reaffirmation of the decisions we made. But also importantly, when competition does move in, the market is a market of 100 million people. The banking system in terms of penetration is only 6% to GDP. So this is a pie that is rapidly growing. The pieces of the pie and what piece is ours is irrelevant in a market that is significantly underpenetrated. So for us, if anything, it reaffirms our forecasts. If anything, maybe it enhances our thinking to the extent that we have allocated more capital to the DRC more recently.
And maybe just to say what Breton said, more competitors make the environment much better. We share the risk of the market, but we have our foot ahead of everybody in the race. And to show the confidence that we have in DRC, we are closing a $71 million increase in capital by September. So that again shows you the confidence we have in the market, the trust we have, the opportunity we are seeing in that market, and the prospects of business. Is there any more questions? If not, oh yeah, thank you.
Thank you. My name is Bella from Bloomberg News. I wanted to know, could you please share your figures on where you're at on trade finance, and if you're able to also share your target for trade finance going forward or by year end? And then I wanted to know how much you've invested in Eurobonds and when or what are their maturity dates. What's your sense of that investment, given how the yield curves for Eurobonds and other markets have played out in the last couple of weeks? What does that imply for you? Thank you.
Maybe those are very detailed data that you may want. It's not top line, so what I will say is I can organize for somebody to support you. Merin Teller will support you after this with the data. But you'll notice that we have the capacity and the tenacity to hold to the market. So we don't see any challenge. We continue to see us continuing to accrue income at 8% from the Eurobond. So from a risk perspective, we don't see it, it's temporary. And the good thing, it doesn't affect the regulatory capital. So we continue to earn the strong returns that we had managed to capture. Unless, Sam, there is anything else you want to say on the risk?
Also, we have a very strong liquidity position, over 50%, as you will see in the presentation that we have provided. So the Eurobonds are held and available for sale portfolio. And so long as we continue to accrue the high interest, as the group CEO has said, and we have liquidity, we're fine. Thank you.
Maybe just so that everyone appreciates the dynamics and how it impacts our balance sheet and our P&L. So as Sam highlighted, our bonds, whether they're the local currency Kenyan bonds or the Kenyan Euro bonds, these are all held as available for sale. So from an accounting treatment perspective, it goes through other comprehensive income. It has no impact on the P&L to the extent that we realize any profit or any losses, which we only intend to realize any profit. The impact is that it goes straight through accounting equity. So you'll see the impact in our shareholder funds. So that's maybe just critical to highlight that it has, and also importantly, it has no impact on our P&L as long as it remains unrealized. It goes through our accounting equity in our balance sheet, so it reduces accounting equity. And then from a regulatory perspective, as James highlighted, it has no impact on regulatory capital. So that is important to highlight. So it by no means changes our forecasts.
But maybe we could also add that ideally, as at 30th June, the interest rates had picked up to, the yields had picked up to 22. They are down to 15. And as a result, you can see the unrealized loss had come down from 60 to 45. We think this is a timing difference because it's an economic cycle, and we have the power and the capability, the resilience to hold to maturity because of our liquidity, because of the growth, and because of the structure of the balance sheet. Any other question? Very good. I want to thank you most sincerely for the opportunity to interact this morning. We took a little bit more because we thought investors need to know and be able to build a predictive model and see where the future lies, so that the decisioning and timing, the timing in the history of equity is very, very significant. And the size of equity and its competitive capability has never been where it is. And lastly, we are seeing a phenomenon that we are liking, that the Eastern Central Africa is slowly becoming one of the fastest growing regions on earth. If you take the 7 countries that we are operating in and compare it with any other region in the world, you might mark it the fastest growing region. We are confident that the world is resetting. The world needs an alternative source of grains. Russia and Ukraine will need time because it's a raw supply problem. And we think the region we are operating in is very, very well positioned to replace the supply that Russia and Ukraine was giving, everything speaks to it. This region can become the grain basket, not just for Africa, but for the world. I'm also convinced that the world has seen the risk of having edible oil, raw materials, 90% of it coming from two countries, Indonesia and Malaysia, and chances are there is a huge opportunity for us to support DRC to bounce back to where it was in the 60s, the largest producer of the raw materials for edible oil. The world needs diversification. We are also cognizant that whether it is electronics, whether it is manufactured goods, the world only depends on 5 countries. I think time for diversification, because of the lessons of the broken supply chains through COVID. Nobody beats East and Central Africa, particularly East Africa, to become the next manufacturing factory for the world. If you want to diversify. The fourth one is we have seen ideology has come back. We thought the Cold War, ideologies of the Cold War are over, but seemingly, it appears ideology is becoming back, and that may cause realignment in focus, in trade relationships, in collaborations and partnerships. We have observed very quietly that every country wants to sign a trade agreement with East Africa, whether it's Britain after Brexit, whether it's Europe, whether it's America, and the Commonwealth. We guess this shows how attractive the region has become and the prospects of this region becoming an investment destination for the world. For us, is to be ready when it happens. Success is when preparedness meets opportunity. We can see the opportunity. We're investing heavily to prepare ourselves so that success will be ours together with our communities because of our shared prosperity model. I thank you very sincerely for being with us and listening with us and recalibrating our understanding, and hopefully the next step is making the right decisions. Thank you very much and good day.
Thank you, James. As we come to the end of the investor briefing half-year 2022 results, the results are already published on the Equity website, and the links are already available. Please follow them. Kindly allow me to invite Bishop Kariuki to close for us with a word of prayer, and kindly remember that breakfast is still served. Bishop
And
Kariuki.
also pick, we have tried to almost put everything I've said and my colleagues on paper in form of a press release, concise, but this was a very important briefing. We would invite Alex to make them available, hard copies, and those who want soft copies can get soft copies so that we acquire the same vocabulary, the same view of the environment and the business that is Equity Group. Thank you very much, Alex.
Thank you, Dr. Mwangi. Bishop Kariuki.
Thank you, and let us pray. Father, we want to thank you again for that wonderful meeting, blessing your holy name for your unfailing support and care. You have always been there, and that is why we've been able to perform, and we want to bless you. We want to thank you for the investors. We want to thank you for making it possible for us to perform. As we go forward, we put our trust in you, that you help us even to move forward and move forward successively and perform even better. We bless you for all of us. As we leave, we pray that your grace and your peace be upon each one of us. We bless you and we thank you for this. We pray in your holy and precious name. Amen.
Every day, over 15 million members are transforming Africa. Million members empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa. 15 million members, empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member. Every day, over 15 million members are transforming Africa.